Hey, Steve Saretsky here. As always, Canadian real estate market update with a particular focus on Vancouver. If you're getting sort of value or entertainment out of these videos, all I ask you hit thumbs up and subscribe. Questions, comments, put those below. Just almost finished up the home office here, so bear with me. But I am testing out a new mic this week, so hopefully the audio by the time this video is posted turns out well. Obviously, would appreciate your feedback in the comments below. But I wanted to frame up this week's video on the premise of, getting the release of the Canadian real estate statistics for the month of December. They just came out. But I think there's really no better way to frame up this whole sort of dilemma and this week's video by some comments by Bank of Canada's Deputy Governor, Paul Beaudry. He made these comments in December, and I think that these are perfectly lined up with this week's video. So let's clip to his comments right now.
Since the pandemic began, Canadian financial institutions have allowed close to 800,000 Canadians to delay payments on mortgages. They've also allowed deferrals on lines of credit and credit cards. This welcome flexibility has kept debt payments down for many households. But the 6-month payment deferral period is ending for most borrowers, and the next few months will be crucial. To this point, the resumption of payments is going quite well. Of the mortgages whose deferrals have expired, the vast majority have returned to regular payments. Only a few have received a second deferral, and even fewer have become delinquent. Obviously, this is an issue we will continue to watch closely. We came into the pandemic with a number of vulnerabilities. A significant portion of households were carrying high levels of debt. Some businesses were more indebted, especially in commodity-related sectors. Some asset valuations, including housing, seemed high relative to fundamentals. The bulk of household debt consists of mortgages, and so we will be monitoring activity in housing markets. Many housing markets have bounced back strongly in recent months. Some of this is pent-up demand built up over the containment period, but there's no doubt the market is being supported by low interest rates. Indeed, this is one of the ways monetary policy is supporting the recovery. We will also watch for signs that housing markets are being driven higher by speculation that prices could keep rising. And we will watch whether people buying houses are taking on outsized debt relative to their income. We're not back to the frothy housing markets we saw in 2016, and we expect the bounce back in housing to dampen. But if too many Canadian households start becoming dangerously over-leveraged, policymakers have several macro-prudential tools they can use. Our experience with the mortgage interest stress test shows how effective these tools can be.
So I have to laugh because all it took to create more affordability or more activity, which again is what the Bank of Canada clearly just said is what they want in the housing market. They want to restart or re-kick the economic engine. They want to get activity flowing, and they're going to go doing that by going back to the well, which is the Canadian housing market. That is basically the backbone, the driver of the Canadian economy. And so it only took Paul and his team $400 billion of asset purchases, quantitative easing, QE, aka money printing. So it only took $400 billion of purchases. But you'll notice he says, okay, well, we were able to drive down, bond yields. We were able to create this liquidity. And we were able to basically, by lowering these mortgage rates, we were able to create affordability. But again, what they failed to sort of elaborate on, obviously, is that, the initial boost from lowering your mortgage rate now in Canada to about 1.5%, yes, it helps with the affordability initially. That is until prices start to catch up and actually rise to ultimately negate or offset that drop in your carrying costs. And so, and again, he goes on further and says, well, unfortunately, one of the things is the poor young buyers, the poor millennials. Unfortunately, it's going to be tough for them to get in because, as he says, it's not the carrying costs aren't terrible. I mean, they're certainly not great in Canada, but the big thing is you're trying to save up for the down payment, And that is where you have this, again, generational inequality or widening wealth gap, where you basically have a lot of millennials that will be locked out of the housing market forever. And unless you ultimately have that help from mom and dad, it's very difficult to actually enter the market and then build up your credit to then leverage that credit to get, accumulate more rental properties, etc. So it really does become a game of widening wealth inequalities, because then now you also have to have, good parents that can also help you get into the market and gift you that down payment. And so this is something that is not unique to Canada. The head of the Australian central bank has also come out and talked about how they're creating these generational inequalities where, unfortunately, unless you're born with family members on that housing ladder, you will probably be left behind. And they don't really seem to have an answer for this. In fact, again, they just keep going back to the well and generating more housing activity. So I think his comments, again, frame up perfectly well, because all we have to do is get a look at the Canadian real estate data for the year of 2020. Forget 1 month, 2 months, 3 months. Let's go for the entire year. So we just had the sales figures coming out. As I mentioned in the previous week's video, to no surprise, the Canadian home sales for the year of 2020, so that 12-month span, you had record home sales. So it beat any other year. It actually even beat 2016. Now, if anybody remembers 2016, we had massive and very blatantly obvious significant offshore inflows, offshore investment, obviously China being the main driver of that, into the housing market, particularly in Vancouver and Toronto. And so despite that speculative frenzy that everybody remembers in 2016, when you had home prices growing by 35% annually, we actually surpassed that in terms of sales in 2020, despite the worst economic contraction that we've ever seen, despite obviously this pandemic, the shutdowns, et cetera, no immigration, no foreign workers, no foreign students. So that basically come to a standstill, and yet you still plugged in record home sales. You have prices accelerating at a pace greater than 1% per month. The latest reading on the national home price is up 13% on a year-over-year basis. Now, again, 13%. That's greater than 1%. And keep in mind that the home price index is hedonically adjusted. It accounts for the sales composition. So yes, there's more single-family houses selling. Yes, the condo market is softer, but the MLS home price index is hedonically adjusted to account for what the product is selling. So on average, you have prices up 13% on a year-over-year basis. And that's a lagging indicator of the way that they accumulate that data. And so you'll probably see that home price index tick up towards 15, 16%, 17% in Q1 of 2021. And so you have this massive runaway in home prices, which again, to Paul's effect is, yes, sure, you've created more affordability by lowering mortgage rates, by lowering these debt servicing payments, particularly for people that are already in the housing market. They are the main beneficiaries of that lowering cost. So you go to renew your mortgage, you were borrowing at 3%, now you're going to renew at 1.5%. That's fantastic. But for anybody that's out of the market, yes, you have that initial gap, but once the prices start to run up, it starts to negate those benefits. But again, this is just where we are in the Canadian real estate and housing landscape. As I said to you, all you have to do is follow the data. I could care less. I don't care if home prices go up, home prices go down. What I'm trying to do here is create a community, a channel, providing education, et cetera. And the ultimate way to do that, you have to build trust, you have to build a brand. The only way to do that is to sort of is really to speak the truth, because anyone can see through that. And so when we look at this Canadian housing data and say, oh my gosh, this guy's bullish, just look at the data. Look at what people are doing. So what I'm following in particular, what I am most focused on, like for my own portfolio, again, I'm not, people ask me all the time, what to do. I don't like giving blanket advice, but what I would encourage you to do is go look at Canada's money supply growth. So M2, so you can literally just go on Google and go Canada M2 money supply. So go look at Canada's M2 money supply. The latest reading we have is in November of 2020. So we don't have December's figure yet, but go look at November. As of November, the M2 money supply was up 13%. So basically they've devalued. The way I look at it is they've added 13% more loonies essentially in the system. So they've essentially added more supply into the market. So they basically devalued the worth of your currency by 13%. So the way I look at it is like, if you aren't getting a 13% return, I would almost argue, this might be a simplistic way of looking at it, but I would almost argue that you're falling behind. Because if they're devaluing the currency, they're adding more supply faster than your investments or your net worth is growing, you're arguably falling behind. So, Canadian home prices, again, up 13% for the year, basically tracking M2. That they just tracked M2. So, was there any real benefit or growth? I mean, you could certainly argue the debates of that. The best growth we can see is in Ottawa, over 20% price growth for the year. And but even then, you had places like Calgary and Edmonton. I think they haven't moved. They haven't moved in over a decade. Prices haven't moved. So actually, if you look at it, that's a real net loss in purchasing power. But even they were up 2%. But again, if you adjust it to money supply, you're still arguably losing money, or you're not gaining any real value in Calgary and Edmonton. So these are things to kind of keep in mind, because this is how I ultimately look at, like, again, my own wealth or portfolio, is just to look and say, okay. And so that's why in the U.S., for example, the Federal Reserve, now this is not just Canada, keep in mind that every central bank is basically trying to flood the system with currency. They're basically printing money to stave off insolvency and to keep the system going. And so I think the U.S.'s M2 money supply was up like 20% for 2020. So this is happening at a massive rapid pace, and that's why I think that it's important to understand these mechanisms and these systems and how they work. But what I'm going to be doing here in the weeks ahead, and some sneak peek preview for this channel, is I am going to be bringing on more guests, more longer form content interviews with some really smart people. So for example, one of the ones that I talked about, we talk about devalued currency, Jeff Booth, he basically wrote the book on central banks printing money and how they aren't able to keep pace with their inflation targets. Jeff is obviously a huge Bitcoin bull, but I would argue again, unless you're hitting that 13% in Canada or 20% in the US, you're arguably falling behind in a real net worth terms. So he's made the big proponent to Bitcoin. That's obviously paid off immensely for him and for many others. And I'm also going to be bringing on, hopefully soon, my buddy Ben Rabideau. Ben is notorious for his research on the Canadian economic landscape and housing and credit space. I would argue that he's actually been on the bearish side for the last decade or so. Bearish tilt, but he provides objective analysis, and he's pivoting hard and getting super, super bullish. So it's very interesting because we've been having these conversations as well. And ironically, he's also getting absolutely ripped apart on Twitter as well for suddenly pivoting and all of a sudden being a housing bull. But keep in mind, this is a guy that advises hedge funds. His job, he can't have a bias. He needs to give them the information so that he can make money off these trades. And that's basically the same thing I try and do in this channel. Is listen, I will give you the information. I will do my best to educate somebody, and then you can use that information to your own benefit and hopefully make some money off of it. But I'm certainly not going to sit here and try to make predictions about where the market's going to be in 6 or 12 months. So I can tell you in depth is what's happening right now, is that you have a runway for rampant price appreciation over the coming months. And as we look forward, we'll have to watch and see how policymakers react. But the reality is, as we've talked about before, I would encourage you to go follow Luke Gromen on Twitter. He's probably one of the best articulate people when it comes to explaining the existing monetary system and the fact that real interest rates, real rates cannot rise, and the fact that you'll basically have every sovereign go bankrupt and delinquent. So basically these sovereign countries, Canada, the US, France, Italy, Greece, you name it. You basically have two options. It's either you print money, you inflate the currency. You print money, you inflate the currency. So you don't default because you print the money. Or number two is you let interest rates blow out, you don't print any money, and you default on your debt. Because all we have to do again is look at simplistically at Canada. So for example, Trudeau government runs a $450 billion deficit this year. And, Krista Freeland comes out and says, it's okay, we can afford it. The interest rates have never been lower. Well, imagine if Krista Freeland's debts, interest rates on her debts go from, 0.25% at the Bank of Canada or whatever. Let's say she's borrowing at 1%. Let's say those blow out to 5%. Can you afford it now, Krista? No, you can't. And so that's the thing, is that there's basically going to be increasing amount of manipulation through the federal government and through the central banks, because they have to slowly and stealthily inflate away the debt and inflate the currency. They need to slowly print the money, make sure nobody notices. Oh, it's okay, inflation's below 2%. We know there's no inflation. Meanwhile, the cost of living is blowing through the roof, as most evidenced in a housing market that is ripping higher in the face of the fundamentals. Simply, there are no fundamentals here. I mean, again, the drivers of real estate, population growth, immigration, jobs, those aren't there. Okay, so you basically, the markets are inflating higher on money printing and on liquidity provided by none other than your financial institutions. So that's all I got for this week. Hope that helped. Otherwise, we'll see you next week.